Scott Wapner. You just heard the bells. We are just getting started. In just a little bit, I will speak to Bitcoin big shot Anthony Pompliano about today's CPI, whether claims that the cryptocurrency is one of the best inflation hedges are just plain wrong. We begin, though, with our talk of the tape. Whether the Great Bear bounce back is dead and that stocks are now heading back to the lows of last month. Our first guest today has consistently made the case that inflation had not only peaked, but that the S&P 500 could rise by nearly 1,000 points by year's end. He's Tom Lee. He is Fundstrat's head of research, joining me once again live. Tom, it's great to have you back with me. Thank you for coming on today.
Yeah, Scott, good to see you. Not a great day for markets, but
no. Are you here today to defend your call or to say I was wrong?
Well, a little bit of both. The last 2 days have been really ugly for markets and really tough for anyone trying to defend something looking better in the second half. But that doesn't mean today's CPI report has really negated anything that is underlying supporting a better second half. I mean, I'd say it's been very disappointing, but today's probably a good example how markets are just losing their patience. They really do want to see an improvement in inflation, but so many things that are driving goods inflation have really started to roll over. And I think in some ways, it's just that the pace of that's not happening fast enough. And of course, that means the markets are just becoming nervous.
Yeah, I mean, food, gas, rent, I could go down the list. Every metric within the CPI, Tom, was so much hotter than expected. And part of your view for the second half is predicated on the fact, as you have continually made the case on this program and others, that inflation had peaked and that it would start coming down. And in fact, it doesn't look like it has in some of the most important metrics there are.
That's true, Scott. I mean, the biggest contributor is shelter, and that's going to have a lag to housing prices because it shows up through rent. So that's going to be sticky. But what might surprise folks is that if you look at sort of number 2, 3, 4, 5 contributors, the next 4 contributors, it was cars, used cars and new cars, apparel, and travel. And these are, travel, of course, is still in its revenge travel phase, but car prices are rolling over and apparel is rolling over and furnishings rolling over and new car sales are slowing, but that just is not showing up in the CPI yet. So as much as I think today was sort of a headline miss and I think, a diffusion mix for people that they think inflation strengthening, a lot of things that are set to sort of be disinflationary are just not showing up yet. So I think it is a lag, and I think markets are losing patience, but I just don't think it means you got to give up on the second half.
You know what? I mean, markets are one thing. I'm thinking about the Fed perhaps losing patience with how sticky inflation is, how tough their job seems to be, and how much tougher it appears today than perhaps it was yesterday, and what that means for the market going forward, and what the likelihood, frankly, is that the Fed has to be even more aggressive than it initially thought.
You're right, Scott. I think from a market's perspective, I think the market would love to see the Fed do more. I don't think that the shock to markets is that the neutral rate is 3 or something. It's really the pace and markets' views about the trajectory. And if it means the Fed has to get tougher and sort of front-end load the hikes, I know that might sound like it's a negative development, but as you know, that might really appease market fears. And for those who are worried that maybe this goes too far and breaks the economy, of course, that's a possibility. But as you know, a big chunk of this rise is really energy prices, which as much as the Fed is going to try to control it, it really is out of their hands in the sense that now the second wave is coming from delays associated with Russia and uncertainty. So I understand why investors are nervous. It's been a tough macro environment and a really tough time to be owning stocks. But I mean, I would even say today wasn't necessarily the ugliest day in the sense that, we haven't necessarily broken to new lows, and it was would have been a perfect excuse for us to actually break to new lows today.
Well, maybe we're on the way there. This is just the beginning. Are we going to retest them?
I'm still in the camp that markets are better risk reward, and so I'd look at stocks to be bought here, but I know investors are just licking wounds, and we know positions have really gone flat. And, today we didn't even see much of a response for the VIX. And I know people might say the VIX has to go to 40, but I think the VIX is telling us, investors are pretty flat here. So it's ugly, been a rough couple days, but that doesn't mean this is where we are in a month.
Barclays says the Fed is going to go 75 next week. The conventional thought is 50. What if there is a surprise, Tom, and maybe there needs to be?
Yeah, from a market psychology, I think equity investors and even credit markets are saying they'd like to see the Fed do more, even though everybody realizes there's a huge lag between what the Fed's doing and the pace of how those kind of come through the economy. But it really is a good moment to try to contain fears, which I don't think are runaway, but, even today's consumer confidence reading, with confidence as low as it is when unemployment is at 3.6%. I looked at this since 1960. Really, the data's pretty good only since 1970. It's kind of unprecedented that consumers are this negative when unemployment rates are this low. So clearly inflation's obviously...
That I wonder, right. That, I wonder, is in part what sort of throws the conventional wisdom, the looks back at history, to the wind, that this time, in fact, is different. You have a variety of dynamics that have made this situation different, and the Fed is going to have to figure it out as it goes. And that's going to be a much more tricky scenario for markets to deal with, which makes your scenario, it seems to me, a little more tricky to reach, even in the best of times.
You're right, Scott. I mean, there's a lot of reasons today's different. There is a lot of moving parts in the macro picture, including war and supply chains, and of course, the size of financial markets relative to the economy. And I think another moving part that we're not seeing visibly right now is what's happening in the private markets, both in venture and private equity. They've been hit much harder by tightening financial conditions because the reference rate there is really, first of all, cost of money is much higher there, but it's really the high yield market, which has widened dramatically. So I do think there are things that we're going to start to see that could slow the economy that are not going to be apparent from blue chip companies doing pre-announcements. And I think that's what's going to help, I think, ultimately the next couple of weeks, sort of ease investors' minds. I think a lot of the Fed tightening is actually already taking place. The market's done a lot of work for them. High yield going up is really slowing private credit formation as well.
I just wonder, I've been thinking about this in preparing for this conversation. And what happens next week if Powell, who doesn't live in a cave, right? He doesn't get everything right, obviously. He's made tremendously big mistakes, and he's admitted as such. But what if he feels like he has to correct the record, if you will? And the big takeaway from the prior Fed meeting was this notion that 75 basis points was, in fact, off the table. What if he shows up next week, makes a concerted effort to say, you know what, it's not only on the table, but it might be more likely in the coming weeks, if not months. What is the reaction then by the market, do you think, Tom?
Well, I think investors do respect the Fed and Powell especially as being quite methodical and data dependent. But as you know, when it comes to how stocks react, sometimes investors want to get the pre-announcement out of the way. So, in that sense, if the Fed were to front load the hikes and say, look, even the suggestion of 100 basis points, which would be a surprise and a negative shock, that would probably help investors be convinced that we're at the beginning of the end from a macro perspective. So they'd be less dependent on seeing the data consistently improve because they think the Fed's ahead of the curve on that.
I don't know. I mean, there are people who say we're already in a recession. We just don't know it yet. How do you respond to them? Because, they're reputable people who are making those claims, and they don't care what the textbook definition would suggest. There are enough underlying issues that they're witnessing and seeing for themselves to say we're in a recession. We just don't know it yet.
Yeah, well, Scott, maybe it's an environmental question. Like you said, it's different times. But in the past, a recession was when a neighbor lost a job, and a depression was when someone lost their own job. But today, I think people have jobs. Maybe a recession is really inflation. And, if someone else is having trouble making ends meet, that's a recession. And if they're having trouble making ends meet themselves, it's depression. I don't know. It's a great question. I think there's still a lot of vitality in the economy and a lot of pent-up demand. and actually a lot of sort of positive things are emerging in the next couple of years. You know, again, like I said, the China COVID-free policy is really pushing companies to reshore back to America. That's very positive for the U.S. Energy security is an important theme.
That's inflationary, though. That's inflationary, isn't it? That's inflationary.
Well, it's both inflationary and reflationary because the U.S. is really better positioned in the future. Actually, and then if there's inflation, as you know, you have to meet it through automation. That's demand for U.S. tech. So I think coming out of this period is going to be great opportunities for the U.S., but it's tough today because inflation is really the single most important metric on, I think, investors and consumer minds. And maybe that's why, like to your point, that's why it feels like a recession. Because now, if everyone's feeling inflation, it's a recession.
Yes, that is my point, right? To the average consumer out there, they're probably thinking, how could a recession feel any worse than what is already happening now when I go to the gas pump or the grocery store, or I try and rent an apartment or find a car, or do countless other things in my life that have increased so dramatically that I'm finding it hard to make ends meet, and I'm living paycheck to paycheck. And even if I make a decent living, salary-wise, I'm still struggling to make ends meet. So this might as well be what a recession is supposed to feel like. So I'm going to hunker down because I can't afford to live in this environment. But let's broaden the conversation out with CIC Wealth's Malcolm Ethridge, who's with us now, too. Malcolm, it's good to see you again. I hope that you've listened to this conversation that I've had with Tom, and I'd like your response to it.
Yeah, I mean, you guys covered a lot, man. I was ready to jump in there. But, yeah, I would say I hope this number coming in today higher and breaking another record puts a lid on the peak inflation debate. I think it's overdue, right? I don't understand what the peak inflation people are even basing this on at this point. To your point, if meat and dairy prices have increased something like 12 to 15% year over year and they're still climbing, fuel prices are up over 50% year over year and still climbing, almost $8 a gallon out on the West Coast. How do we know we're at the peak of anything, right? So this could also make it that much easier to make the statement that you just laid out there that we are in the middle of a recession and just don't realize it yet. Because to your point, if a third of U.S. households making over $250,000 a year are reporting living check to check, then what the heck is happening to the people making $150,000 in household income? And that's a much larger percentage of the population. And also those are the people that are more likely to be spending every dollar that's coming in trying to keep up with inflationary pressures. And so if those groups of people with that level of income are telling us that it's a recession, they're not shopping at Target, sales are down. They're not shopping at TJ Maxx, sales are down. They're not shopping at Walmart, sales are down. That's the Main Street indicator that tells me we're already in a recession. We just don't want to admit it to ourselves yet. We want the party to keep going on because it's felt really good.
Forgive me for stepping on your toe there, Malcolm. What does it mean for where stocks ultimately go from here? Because, I mean, that is the question of the moment. Everybody is thinking about the same question. What does it mean for my stocks? I'm thinking about longer-term investments, college savings plans, retirement plans. We're all in the same boat. We're all worried about sort of what the environment is heading into, what it means for the stock market. What do you tell people?
Yeah, I would say if you're a person who is actually expecting to need to tap into the savings that you have that are in the market today, maybe this trading range we find ourselves in of $4,000 on the S&P up to, what, 4,300 or so. We've been meandering in this trading range for like 3, maybe 4-ish weeks. Maybe this is the range where you start to look at that exit ramp and say, you know, I need this money sooner than I thought I would. This might be a place to get out even though it doesn't feel good. If you're a person who's thinking more long-term, the next 12 months or so, you have to worry about tapping into that savings, then this doesn't really matter because we start to get positive earnings toward the back end of the year. We start to see, you know, companies focus more on profits and you know, surge our way back out of this, and you're fine. But it's the folks who have a more short-term time horizon actually need to be tapping into those dollars that they have invested that should be reassessing that time horizon and deciding whether they should not be in this market right now and heading for the exits.
It's hard to feel good about even the long term, Tom. I think you can understand that, even though you think that the second half of the year is going to be better than a lot of other people think. If you are looking at a storm developing on the horizon, you're assuming it's coming your way. Now, it may blow over. It may come over the mountains and break up. We just don't know. So it's awfully difficult for people to get their arms around this idea that the second half of the year can bring us to a point where we can go up 900 to 1,000 S&P points if we've got all these issues in front of us, Tom.
That's right, Scott. I mean, bottoming processes are very difficult for people because in people's mind, the math is, if you're already down 50% and you go down, you're down 55%, you've just lost another 10%. And that's why markets feel so choppy right now. But from another perspective, I just think that we've got a lot of positioning, cautiously positioned for investors. And if things are improving, I would say you're right. It's choppy. I think it's actually constructive that we didn't make new lows. Technicals are really important, and our technical strategist, Mark Newton's done a really good job helping clients tactically here. But again, what I would just caution investors is not to just give up on equities, because at the end of the day, the best performing asset class in an inflationary environment is actually going to be stocks, because nominal earnings will grow. I know there's going to be a lot of questions about companies having to cut earnings, but at the moment, I would just say you have to keep in mind, if companies are able to pass on price, which is why we are seeing CPI, they're not the ones that are going to have the earnings problems. It's ultimately where we start to exhaust demand. And so far, that is not, the entire economy. It's more showing up in things like cars and housing. And those are the things actually the Fed wants to see start to slow down.
Yeah, well, speaking of the Fed, is how are they going to, Malcolm, and we'll make this the last word, how are they going to be able to engineer this slowdown that Tom is talking about in some of the areas that have experienced the hottest of inflationary reads? I was speaking with Jeffrey Gundlach, who, by the way, is going to be on with us on Fed Day next week, as usual, to react instantly to what the Fed has done and said. And I just exchanged an email with him, and I want to read you what he said to me when I asked him, what does all of this today mean for the Fed? Trying to get a thought from him leading into the meeting, since we'll speak with him on the way out. He says, from its low on May 4th Fed Day, the 2-year U.S. Treasury yield is up 47 basis points. Since the Fed follows the 2-year, the Fed is now just as far behind the curve as it was before the 50 basis point hike of last month. Malcolm, the implication here from Mr. Gundlach is clearly that they are going to have to be super aggressive going forward because of how far behind the curve they remain.
Yeah, I took your point about how the Fed consistently gets it wrong, has gotten it wrong, has admitted that they've gotten it wrong, but I don't see really any attitude toward meaningful change. Like, I think realistically, we have to jump over 75. 75 shouldn't even be part of the conversation anymore. We should be talking about going to 100 basis points at this point in June to signal to the markets that the Fed is dead serious about putting a lid on these inflationary numbers that we just got through talking about. And I think it's very unlikely that they do anything but stick to the 50-50-50 June, July, and September that they've already forecasted, because they don't like deviating from the course too often. And so I don't think the Fed is ready and planning to do the hard thing, which is to slam on the brakes so hard that we hit the windshield. But I do think that that's realistically what it would take to get a handle on things like autos and homes and those kind of things that Tom just mentioned.
Well, you and Mr. Kramer should have a mezcal together, because you guys clearly agree on what needs to happen from the Federal Reserve, as does, by the way, Jeremy Siegel, the professor from the Wharton School, who was on the halftime report and said as such. Guys, it's great to see you.
Good company.
Thanks so much for coming on. I really appreciate it. I know our viewers do as well. That's Tom Lee, Malcolm Ethridge joining us there. To our Twitter question of the day now, we want to know, how many basis points should the Fed hike at Wednesday's meeting? Is it 50, 75, or 100?